Okay, so this is my second clip on your Chapter 18 material on fractional reserve banking and open market operations. So in the last clip I got to cover bonds. Okay, just to make sure we get this point clear, the entity that borrows money will view the bond as a liability. Why? Because that entity will have to make coupon payments into the future, right? Could be for the next 30 years. And if they're paying them out 2 times a year, every 6 months, that's 60 more payments. And it's also a liability because in the future they have to pay back the principal, the par value, the face value, whatever you want to call it. Okay, so that will be a liability from the borrower's perspective. However, a bond can also be viewed as an asset, and it's an asset from the investor's perspective, because the investor, that's the person who gave the money up front in the first place, who lent the money out initially, they're the ones who are receiving a flow of income, right? They're the ones who are depositing into their account the coupon interest payments, and eventually, 30 years from now, the initial principal. Okay? Okay, so that's the bonds. Let me continue. Currency. Let me just stop this. I have some people on MSN sending me messages. All right, so let me get back here and get back in the game here. Currency. We're talking about currency in this analysis. What we are talking about is those pieces of paper that say Bank of Canada on them, right? So your $20 bill, your $10 bill, your $5 bill, your money, right? And the coins. Okay, so that's currency. Now remember, currency again can be viewed as an asset or a liability, right? If I have some money in my wallet, that's an asset for me. And in fact, we would say that this is a liquid asset, right? Because it's in the form of cash, right? Liquidity means cash or ease to convert into cash. So cash obviously is the most liquid of assets because it is cash. So there's no real big complicated conversion process. What that means is, like, let's say you're a retailer and you're selling merchandise. It's less liquid because maybe that shirt has to hang on the shelf for 45 days before someone buys it, and then you get the cash. That's what I mean by conversion process. But currency, remember, again, is a liability of the central bank. Okay? As I showed you on my first PowerPoint slide setup, it was on the right-hand side. It's the biggest one. Remember, in the Canadian, it was like $29 billion. Right? It was, I think that's what it was. Yeah, something like that. It was the biggest number on the right-hand column. So that's currency. They crossed it off the list. Okay. The next thing is this term called reserves. And again, reserves can be assets or liabilities depending on what perspective you look at them from. Reserves are assets to private commercial banks because it's their reserves. Okay, it's their reserve of cash. And these private banks hold these reserves, or keep them, store them, at the central bank. Okay, so central bankers are storing them. So from the central bank's perspective, a reserve is a liability, right? Because the central bank is liable to, in the sense that if the private banks show up and say, give me my money back, then the central bank would have to give it back because the central bank doesn't own the reserves. The private banks own the reserves. So the reserves are assets of private banks and their liabilities of the central bank. And if you remember from my discussion before, currency plus reserves, which are both liabilities of the central bank, together, if you add them together, constitute the monetary base, which is also called the central bank money, and is also called high-powered money. As you will see at the end of this discussion, why it's called high-powered. Okay, because basically it gets sort of juiced up through this whole banking system. And it grows and grows and grows. It's bigger and bigger and bigger. Okay. If you increase it, of course. If you subtract it, then the whole money supply shrinks, of course. Anyway, so that's the monetary base. Okay, next, deposits. Again, deposits can be assets or liabilities depending upon which perspective you look at it. Okay, now I'm going to use a slightly older explanation because obviously today we use direct deposit. But a little while ago, when people worked at a job, they would get a paycheck. And they would literally get a piece of paper or a check. Okay, so they would then, of course, walk down to their bank and they would deposit their check into their checking account. Okay, this, of course, is an asset for the worker, right? Because this is their money. It's their asset. It's something of value for them. But that same deposit, from the perspective of the bank, is a liability, because the worker could walk in one day and say, I want to withdraw my money. Give me my money. And the bank would then have to pay out. And so that's why it's viewed as a liability of the central bank. The liability of the private bank, because the private bank is liable to pay out something, okay, which is the deposit of the worker. Okay, so deposits then are you as the private citizen. It's your asset, but that is viewed by your private commercial bank as their liability because they owe that money to you. Okay, so that's deposits. Okay, so we got currency, we got deposits, we got reserves, got monetary base. The last thing in this analysis is there are two ratios. Okay, one's called the reserve ratio, and the other one, I don't know what they call it, but it's basically like I'm going to call it a cash ratio. Okay, it's basically just a ratio of currency to deposits. And that's what, in this analysis, ratio basically just means fractions. We're going to take one number and we're going to divide it by another number. And in this analysis, in both fractions, this is kind of helpful to remember, the number on the bottom of the fraction, the denominator, is always deposits. Okay, so these are your deposits that private citizens put into private commercial banks. And then it's the top part of the fraction, the numerators, that change. In the reserve ratio, this is shocking, I know, the numerator is the reserves. So reserves divided by deposits is called the reserve ratio. And then what I'm calling this cash ratio, this is a shocker, is going to be currency, right, the cash, divided by deposits. That's all it is. And that basically is enough to give you the background of this whole fractional reserve system. So on to video number 3.